Okay, so growth cools, but the consumer isn't gone, and the economy right now has the exact energy of someone saying, "No, I'm fine," while sitting down very, very slowly.
So, last week gave us plenty to work with, so if you missed those breakdowns, go catch the episodes on the Fed meeting, oil prices, and inflation, because all of that feeds directly into why this consumer story feels a lot shakier now.
Welcome, everyone. This is Weekly Market Breakdown. Subscribe for more sharp, funny takes on the economy and markets each week. Today, we're talking about slower growth, a consumer who is still spending but not exactly thriving, and why the economy can look okay in the top line numbers while still feeling, weirdly stressful underneath.
The headline says resilient, and your bank app says, let's not do anything dramatic this week.
So, start with growth. The government's revised estimate showed the economy grew at a 0.7% annual rate in the fourth quarter. That was down from the earlier 1.4% estimate and well below the third quarter's 4.3% pace.
So the economy did not stop. It just went from I got this to let me sit for a second, Kyla.
Yes, and those revisions matter because they tell you the earlier picture was too rosy. Consumer spending was revised down, exports were revised down, government spending was revised down. So this was not just one weird category distorting things.
I love that GDP revisions always sound so polite. We have updated the estimate. Yeah, to reveal the economy was more out of breath than previously advertised.
That is basically it. And one of the useful cleaner measures in there, real final sales to private domestic purchasers, came in at 1.9%. So private domestic demand was still positive, but again, not exactly booming.
Which is economist language for people are still buying things, but nobody is cartwheeling into a Best Buy.
Pretty much, Jordan. And that takes us to retail spending. January retail and food services sales were around $733.5 billion. That was down 0.2% from the prior month, but still up 3.2% from a year earlier.
So the consumer is still in the game, but maybe no longer with the confidence of someone tossing extra stuff into the cart for fun.
Exactly. And that is the important distinction. Spending is still happening, but that does not mean households feel good. It does not mean they feel secure. And it definitely does not mean everybody is experiencing the economy the same way.
Right. Consumers are spending is one of those phrases that can mean anything from people feel optimistic to groceries remain weirdly mandatory.
That is exactly right. A lot of the spending that stays strong in a period like this is essentials, replacement spending, or purchases from households with more income cushion. That is very different from broad-based comfort.
So the headline is the consumer is resilient, but the subheadline is please note that resilience here may include stress buying shampoo and canceling travel.
Yes, and the National Retail Federation's outlook reflected that tension. The group projected retail sales growth of 4.4% this year, which sounds healthy, but they also acknowledged the environment is volatile, and a lot of the support is coming from stronger households.
Which is like a polite way of saying the economy is being held up by people who can still accidentally buy patio furniture.
Exactly. And that unevenness matters a lot, Jordan. Aggregate spending can look okay, even while a big part of the country feels squeezed. Higher income households can keep the top line numbers afloat, while middle and lower income households feel every extra dollar in gas, rent, food, and debt payments.
That is the thing people hate about macro headlines. The average can look respectable while half the country is doing calculator work in the cereal aisle.
Yes. And then housing makes it even harder. Mortgage rates were still around 6.22% this week for a 30-year fixed loan. That keeps affordability tight and basically extends the period where a lot of would-be buyers feel stuck.
6.22 is one of those numbers that sounds almost boring until it turns into a monthly payment and then you just quietly close the tab.
Exactly. Housing spills into everything too. It affects moving, remodeling, appliances, furniture, and people's willingness to make other large purchases.
Right? Because when your housing cost is unstable or unaffordable, suddenly the couch, the fridge, and the maybe we should move conversation all start to feel cursed.
And this is where the oil story feeds back in. If energy costs stay high, households spend more on necessities and have less left for discretionary stuff. So even if spending looks okay now, the mix can start to deteriorate.
That is the sneaky part. The consumer does not vanish overnight. They just get more upset about every purchase.
That is actually a great way to put it. Like they become more selective, more price sensitive, more cautious. Maybe they downgrade brands, skip non-essentials, put off travel, delay home projects.
Yeah, and businesses feel that fast. One day customers are showing resilience, and the next day they are saying, actually, this scented candle is not part of my long-term financial strategy.
Exactly. And that is why this softer growth environment matters. When the economy has strong momentum, it can absorb shocks better. When momentum is already slower, higher oil, higher rates, layoffs, or weaker confidence do more damage.
So the problem is not just that growth cooled. It is that the cushion got thinner.
Yes, that is the whole story in one sentence, really. The cushion got thinner.
Wow, that sounded so reasonable, I almost forgot I was supposed to make fun of it.
You can still make fun of it.
Okay, great. The US economy is basically a couch cushion now. Technically still there, but less supportive than everyone hoped.
There it is. And this is why the consumer story matters so much. Consumer spending is a huge part of the economy. If households keep hanging in, growth may stay positive even if it feels sluggish. If they start pulling back more sharply, the slowdown gets more obvious.
And people do not wait for economists to officially name the slowdown. They know when life starts feeling like all fixed costs and no breathing room.
Exactly. People experience vulnerability before they experience headlines. They feel it in grocery totals, car repairs, rent, insurance, and the fact that every small expense suddenly requires a tiny emotional summit.
Yeah, when you have to think hard before buying takeout, you do not need a GDP revision to tell you the vibe changed.
The big uncertainty now is whether the consumer keeps absorbing all this pressure, or whether higher fuel costs, elevated borrowing costs, and softer growth finally push spending down more noticeably in the next few months, Jordan.
Translation, is the consumer still the hero of this story, or are they about to request some backup? Well,
We'll keep watching the data so you do not have to open your bank app after midnight and wonder why discretionary income now feels more like folklore than a real category.
the numbers are wobbling, the bills are loud, and the economy is once again refusing to act normal. Subscribe, check out the other breakdowns, and follow for more.